So hi everyone, I'm Colin, a portfolio manager at iFAST Global Fixed Income team. So it is good to be back here and to share with everyone and see everyone in person. So this year, the theme of our event is finding the perfect match. Right? So my job today here is very simple, is to convince you guys that bonds are the perfect tool to navigate the current turbulent market. And ultimately, and more importantly, it is a tool that you can utilize and profit from having them in your portfolio. So let us start off with this chart right here, which is a recap on bond market performances. So over the past 6 months, the entire bond space have demonstrated very resilient and healthy recovery. So this is a very strong recovery. And as you can see, both the investment grade as well as the high yield bond universe have returned around 7% and above in US dollar terms. So this is nearly equivalent to the global equity market return of 10%. So very near equity-like returns. And one major driver for this strong performance was the fall in global interest rates. So over the past 6 months, most central banks have cut rates. And they have cut rates on the basis of softer economic growth and weaker inflation numbers. So this has resulted in the fall across Treasury yields over the whole entire global interest rate bond space. And this in turn have greatly supported bond prices. And if you look at investment grade bonds, they have recorded the strongest return of about 7.4%. And this was fueled by a flight to safety across the past 6 months as economic conditions softens. And meanwhile, the returns from high yield bonds were largely supported by the high-yielding nature of their underlying instrument, which yields about 6 to 7%. So now that we have an idea of how bond markets have performed, let us turn our attention to the future. So while I do not have a crystal ball, I certainly believe these bond markets have room to recover further in the second half of this year. Having said that, there are several important drivers that I want to highlight here today. And here are our recommended strategies. So let me elaborate further. Firstly, global yields have been trending down and may continue if economic growth worsen, and this gives central banks more reasons to cut rates. But meanwhile, if you look around, geopolitical risks as well as weaker economic growth will also weigh on credit fundamentals for bond issuers. And as a result of this, we recommend investors to stick with high-quality bonds to protect yourself, to lock in more stable and durable income. And investors can also consider putting cash to use in a falling yield environment. And that is to also consider treasuries remains a high-quality, risk-free option for many investors. At the same time, we also recognize that the potential for tariff-related inflation to come back to bite us. So this may show up over the next few months, adding to a lot of risk for a stagflation scenario. And this may influence central banks to hold interest rate at current levels, or even to exert outwards pressure in treasury yields as market prices in a higher inflation outcome. So considering this backdrop, we will also recommend investors to keep interest rate risk in control, and we prefer short duration bonds. And in my remaining presentation, I will share with you guys more on these 3 points of what and how to invest. All right, let's start off with why we prefer short duration bonds. So as you can see from this chart right here, quite clearly over the past 6 months, we have seen major central banks cutting interest rate on the basis of slowing inflation numbers. So this chart here shows that policy rates across major central banks have largely declined, except the Fed as well as the BOJ. So for example, if you look at the ECB, it has cut rates by about 100 basis points, and this was followed by another 50 basis points from cuts by the BOE, for example. That said, we caution against extrapolating this trend, and we caution against assuming that the rate cuts will continue significantly like we've seen over the past 6 months. And in fact, many central banks which have cut rates significantly have kind of changed their tone over the recent months. They are starting to express concern about potential tariff-related inflationary headwinds. So they kind of see some of the trends are coming back in, and they have communicated to many of communicated to markets that they are likely looking at slowing the pace of rate cuts and as well as potentially pausing rate cuts. And because of this, we do think that this will put less downwards pressure on short-term yields. And with less downward pressure on short-term yields, short duration bond yields may remain competitive over the next few months. So at the same time, when we look at the central bank, the most important central bank to many of us is the Fed. So we think that the Fed itself is trapped between the rock and the hard place to cut rates to support growth or to hold rates to combat inflation. But given this predicament, we think that the Feds have kind of expressed their desire to remain cautious in cutting rates. And also at the same time, we look across the data for labor market, it remains resilient, and look across the data for inflation. While it has softened, there are many areas that have slowly and started to pick up, especially the survey, the soft data. So overall, we think that the Fed is in no rush to cut rates, which will keep markets' expectation of rate cuts in check, and therefore short-term yields, especially short-term US yields, can remain supported at current attractive levels. So the big question here for everybody is, will the Fed cut rates? We think it is possible, especially if US labor markets continues to weaken. And if they do cut rates, we do think that the room for rate cuts it will be limited because of inflation concerns. So we do not see a significant downside in US yields, at least in the second half of this year. So another reason why we prefer short duration bond is largely influenced by the shape of the yield curve, as you can see from this chart right here. So the shape of the curve, as you can see, has steepened over the past 3 months. And however, if you zoom in into the red circle over there, you can see that short-term yields remain attractive and have not dropped significantly, particularly for those that are 1 year and below. So if you were to invest in the 1-year US Treasury bills right now, you are likely to get a yield of around 4% for risk-free incomes, where many times in the past, you might have trouble getting yields of just even close to 1%. So you're getting a high amount of yield for short-term US yields today versus the past. And given elevated short-term yields, we also think that longer-term Treasury yields are not offering enough yield pickup to justify taking on so much more interest rate risk. So right now, if you look at the 10-year Treasury yields, we are getting around 4.3 to 4.4%, which is only 30 to 40 basis points higher than the 1-year Treasury. And this does not justify, certainly, the additional interest rate risk we think that you will be getting if you extend the duration that much. So we think that the compensation will be fairer if the 10-year US Treasury yield move towards high 4s or even 5%. So furthermore, we also think that the US long-term yields may face upwards pressure, and this will come in the form of concerns over the US fiscal conditions as well as inflation risks. And overall, for investors, this means more price risk as the yields may become more volatile on the back end or even rise further, resulting in a downside price risk for long-term US Treasury yield bonds. So what can you do if you want to add duration? I think that is the next big question in everyone's mind. So we do recommend you to do so through investment-grade corporate bonds. As you can see from these two charts right here, the yield curve for the US dollar as well as the euro corporate bonds are much steeper than their Treasury counterparts. So this suggests that you can achieve the same level of yield through investment-grade bonds, but with a shorter tenor. So let me give you an example. Right now, a 20-year US Treasury yield gives you around 4.8% yield, but you can achieve that through a 5 to 6 year US dollar investment-grade corporate bonds, which is effectively cutting the duration exposure significantly. And of course, the trade-off here will be the exchange for that the duration risk for higher credit risk. But we think that you can minimize that credit risk by choosing a high-quality investment-grade issuer or an investment-grade bond index that can minimize that credit risk and also default probability. So overall, given our preference for short duration bonds, we do recommend investment such as the short ultra short, liquidity, as well as money market products. So here's a list of the recommendations, and in the consideration of time, I will not go through them, but I will have a slide at the end to show everything again for those who want to take a picture. All right, so our next recommendation for investors is to stick with high-quality investment-grade bonds, IG bonds for short. And IG bonds in general is a segment that we have been positive on over the past 1 year. So one of the biggest reasons why this space remains compelling to us is that you can see from this chart here is the level of yields that it is trading at now relative to history. So today, global investment-grade corporate bonds are still offering an attractive yield of around 4.5% on an index level. And this is much higher than what you can get over the past 20 years, which is around 3.7%. And you can even get higher yield if you invest directly into investment-grade corporate bonds. So the table on the right shows some of our recently recommended investment-grade corporate bonds, and they all offer a yield of between 4.8 to 5%, yield to call and yield to maturity respectively, with a reasonable tenor of about 3 to 6 years. And if I can show one chart on the attractiveness of investment-grade bond yields, I will show this chart right here. So there are two things you can take away from this chart. Number one, you can see that within the box area, the US, Europe, and Asian investment-grade bond yields are not only above their long-term average, but also near the top end of their historical range. And also, the second thing you can see here is that if you look at the high-yield bond yields, which are the three components in the middle, you can see that they are mostly below their historical average, which is completely different from investment-grade bond yields. And this makes investment-grade bond yields relatively attractive to their high-yield peers. And this leads me to my second point, and that is that high-yield bond yields on average are not offering significant or enough compensation for investors for taking the extra credit risk. And if you look at this chart, you can see that because of the drop in yields, it becomes to a level where there is not much need for credit differentiation. So what do I mean by that? At the moment, the extra yield an investor may get by choosing global high-yield bond over IG bond is only about 2.6%. And this is near historical lows, while on average, the investors should be looking to get around 3.7% yield. So that is 3.7% yield pickup by choosing a high-yield bond index. So simply put, investors are not adequately being compensated for taking the extra credit risk. So ultimately, my point here is that investment-grade bonds, which are usually seen as boring, not sexy, and low yield, have finally become a strong income contender at the moment, and investors should not miss out on these opportunities to lock in yields and lock in this durable income over the next few years. But for high-yield bonds, I'm not suggesting to avoid it like a plague, to stay out of it completely, but rather we advise investors to be selective, to pick stronger issuers amongst the high-yield pool. So bond yield itself can also be a proxy for returns over a given time horizon. And the chart here shows that buying investment-grade corporate bonds when yields are higher has often translated to a stronger forward return. And in other words, higher entry yield correlates with stronger future returns. So for example, if you're buying a global investment-grade corporate bond index at a yield of 4.5%, this has historically translated to an annualized return of about 4.5 to 7% over the next 3 years, which is pretty attractive, right? But to be clear, I'm not suggesting that you are guaranteed to get this type of return. But for long-term investors, we do think that this return profile is compelling. And I also wanted to quickly highlight the benefits of investment-grade bonds on a portfolio level. We don't want to just see investment-grade bonds as just an investment vehicle, but at a bigger picture, we want to see how it can harmonize with an equity portfolio. So this table here shows that investment-grade bonds have recorded very low correlation against major equity indices over the past 15 years, over the very long term, and even against the Straits Times Index, which many of you are familiar with. So this is unlike high-yield bonds, which you can see from the last row that showed demonstrated equity-like correlation. And these are much higher than what we see in investment-grade bonds over the same period. So for investors, the takeaway here is that investment-grade bonds are suitable natural hedges against equities, which can improve your portfolio diversification and reduce the overall portfolio risk. So before I go into my last point, here are some recommended products for global as well as Asian investment-grade bonds. And if you're looking at individual bonds, I will refer you to our FSMOne website or even the BSM Bond Supermarket webpage to see a detailed list of our recommendations. So for my last investment message, this is mainly targeted at investors looking to deploy cash for a low-risk, liquid return, and for this, we recommend treasuries, and in particular, we do think that the US treasuries offers decent yields amongst government bonds. It is also available to all retail investors, and the interests are tax exempted. So what are the ways you can use treasuries to your advantage? So one way to use this is to lock in risk-free yields through a treasury ladder as depicted over here by the chart. So the goal here is to have a portion of the treasury mature every single year. And this allows you to reinvest the treasury that matures or even redirect them as emergency funds if needed. So let's say you have a 30K saving, you can split this into 3 and buy 10K of treasuries across the 1 to 3 year tenor. Then every year you have a treasury maturing, providing the proceeds for a consistent stream of income as well as a liquidity. You can also use treasury as part of a diversified liquidity strategy. And for this strategy, what you want to do is to prioritize having low risk over higher returns, which is why treasuries work well here. And this strategy can be implemented through a simple 3-tranche approach. So this is just a simplified example. By having exposure to products that gives you liquidity in the ultra short term for your daily needs, in the short term for non-immediate expenses, but with products that's still giving you higher yield, and lastly, in the longer term with products dedicated for income investment. So this illustration here shows how you can structure a liquidity strategy with some of these products. So US Treasury will fit well into this strategy, and you can add US Treasury bills as yield enhancers considering the high short-term yields, but even fit in the long term where you can dedicate a portion of the investment to be risk-free to balance out other riskier investments. So you can also consider US Treasury notes which are equally liquid. And last but certainly not least, treasuries can be used to express your view on duration and even enhance portfolio returns. So for this, investors do not need to hold US Treasury to maturity, and these two charts here shows the estimated total return of the 2-year and 10-year US Treasury in 12 months based on how much their respective yield will move in the following 12 months. So if your yield hits the target, netting you a decent return, you can always sell off a US Treasury to crystallize those gains. So again, this is one way where investors do not need to hold on to US Treasury to maturity, and you can, of course, trade US Treasury in this manner. So for US Treasury investors can check out Bond Supermarket Live for a wide range of available US Treasury. So Bond Supermarket Live is a centralized bond marketplace where orders are matched dynamically, offering investors a live trading experience. So BSM Live also offers the benefits of live and transparent prices, the ability to trade instantly, enhanced price discovery, better liquidity, and lastly, the access to a deeper pool of market participants. So here is how you can access BSM Live on the FSM page, and do note that the accredited investor status will apply for trades in smaller denominations. So before I end, I will leave you with a summary of our investment ideas, and if you can't remember what I've shared during this presentation, don't worry. This slide captures the key parts and most importantly, the recommended products. So as I've said in my starting slide, I hope I've convinced you guys why bonds are a perfect match to help navigate the ongoing market uncertainty. And with that, I come to the end of today's presentation. Thank you everyone for your time.